Good morning, it's Jeff Christian. It's about 11:40 on Friday, the 10th of September, 2021. Talking to you today from New York. I want to talk about the risks abroad in the world. At the end, I'll mention the Silver Symposium, which is coming up at the end of September in Coeur d'Alene, Idaho. I'm going to be speaking there. 3 different things I'm going to be doing. And I would welcome you all to come to Coeur d'Alene and attend the Silver Symposium. It could be a very interesting event or not, but I think your presence would make it much more interesting, at least to me. It's kind of weird talking about the risks abroad in the world today, given my message and the fact that it's the 10th of September. I had a very good friend, David Nelson. He worked at Car Futures, which had been part of Dean Witter Reynolds. And on September 10th, 2001, we were talking on the phone. We had about 3 different pieces of business or topics to discuss. And David said, look, let's have lunch tomorrow and we'll talk about these things. Dean Witter was on a high floor at the World Trade Center, Car Futures was. I had a standing offer to go work for them anytime I wanted. I had never taken that. Everyone that went to Car Futures that next day, September 11th, 2001, died, including my friend David Nelson. We never had lunch. So it's kind of weird to talk about risks when I missed that one. On my 4th birthday, Waylon Jennings was a bass player for up and coming rockabilly guy. And his band leader, Buddy Holly, said, hey, Waylon, I was going to have you fly on my plane, but I want you to give your seat to the Big Bopper. So Buddy Holly and the Big Bopper were in the plane when it crashed, and Waylon Jennings survived. Those are risks, kind of bizarre risks. You walk away from a plane accident that you could have had. You walk away from the fact that you could have died 20 years ago if you had taken an interesting job at an interesting company. We see risks and we see problems. We talk about them all the time. They're not catastrophic failures to the world. And that's, I think, the big difference between CPM Group as a research company doing real research and fear mongers who try to sell you snake oil, who try to cause you to panic. So I want to talk about that today. Somebody who has known me for half a century and has known my work said a few years ago, Jeff, it must be killing you knowing your personality and the fact that you really don't want to be part of the crowd to hear everybody talking about black swans, because you have dedicated your life researching black swan events. And I have, and that's what I've been doing. And the concept of a black swan event has been depreciated by its misuse by the fearmongers and others who really don't understand what it is. A lot of things are not black swan events. They're bad things, but you can see them coming. You can see them coming like a red light going down the highway. It's not there. Black swan events are special events, but there are a lot of other critical events. And the reality, which I want to talk about today, is that the economy has and can absorb and recover a lot of $5 trillion, $10 trillion losses over and over again. It has so far, and it will continue to. Past risks, there are many. I put down the 1970s in general. They speak for themselves. In 1983, there was a bond that blew up from the Washington public power supply system. These were called Whoops bonds. The Washington State public power supply system had borrowed an enormous amount of money because it wanted to build out a fleet of nuclear power plants. And nuclear power plants in the late 70s, early 80s, were swamped with cost overruns and delays, as they are today. And we were in the backwash from the 3 Mile Island thing. It all went bad and they defaulted on their bonds. And I remember watching the news that night and with my wife, and they had some fellow who had put his life savings in 14% whoops bonds, as they were called. And the guy was saying, I didn't think that there was a risk like this in these bonds from a state agency. And my wife just turned to me and said, so why did he think they were paying him 14% to borrow his money if there was no risk? There are always risks there. The Southeast Asian currency crisis in 1997, the Russian bond default in 1998, long-term capital management blowing up in 1998, the tech boom and bust, which I want to talk a lot about because I think it is a very close approximation of what we're seeing with cryptocurrencies today. But I'll get back to that. Enron and a whole host of corporate scandals in 1999, 2000, 2001, 2002. The subprime mortgage debacle in 2007, 2008, 2009. The ECB crisis in 2011. I can go on and on. The question is, what do we see now and what do we see going forward in the future? And one of the issues that a lot of people are worried about are the private cryptocurrencies. I think that's a scandal that's waiting to happen. I'm pretty certain that it is. I think that the tech boom and bust of the late 90s into 2000, 2001 is a perfect example of how it'll go wrong, but we'll get back to that. And I don't think that it's a critical factor for the global economy or even the stock market. A lot of investors will lose a lot of money based on it, but we'll all survive. SPACs, special purpose acquisition companies, are a bigger problem, as is, I think, the shift away from public equities to private equities and the valuation of those private equities and their holdings. And I think that those are bigger issues, another scandal that could come. I've spoken in recent videos about equities and equity derivatives and the mismatch between equities and equity derivatives. I still think that's an issue. I think EVs, electric vehicles, even though I wrote the book on them in 1979, I think electric vehicles and the move and the push toward electric vehicles could cause a lot of problems. First off, I don't think that they can build market share as fast as a lot of people say. I think that they're being missold. When people realize that electric vehicles might clean up the pollution in a city, but they don't really help climate change because they don't necessarily reduce the amount of carbon dioxide being put out. They simply shift it from the cities where cars burn petroleum products to the power plants outside of the cities where the power plants burn coal, natural gas, and still some petroleum products. I think that that could be something of a problem, and it could lead to some major losses across the industry and the economy. And your neighborhood deli. You might not know who your neighborhood deli is, but it was a deli in suburban New Jersey that became a publicly listed company. It was pretty much a joke of a company. I'm not quite sure what the fellows were doing with it, but it had a market cap of $113 million. And your neighborhood deli is just one thing. There was a company, I think it was called metals.com, in the precious metals industry. It's now in receivership. There are a lot of things that are just not real that can come back to haunt us. But I don't know that they're tragic. They're problems. A lot of people are going to lose a lot of money in them, but the world will continue. Let's look at it. The tech stock boom, which, as I said, this is thousands of shell companies. We were watching this in the late 1990s, and you had kids in their dorms pulling together a 5-page business plan with their buddies and then raising hundreds of millions of dollars for tech companies. And there were tens of thousands of these companies that were created that became really big in terms of their market cap. Investors were pouring money into them. When they realized that there were no assets behind those companies, they collapsed. $5 trillion was lost. Then this was 2000, 2001. Adjusting for inflation, that's about $8 trillion that was lost in today's dollar terms in the tech stock boom. People look back and they say, well, you know, some really good companies came out of that. And they rattle off less than 10. Yes. And the problem is that people are comparing the larger tech companies that built up at that time to the broader tech bust. And you have this, what they call survivor bias. You see this, for example, with hedge funds. Hedge fund performances, indices of them, and the data that's gathered on it is always over counting the profitabilities, because they only measure the profits and the assets under management of the companies that have survived. And there's this tremendous attrition of smaller hedge funds that come, lose money, and go away, that don't get picked up in that data. It's survivor bias. It's a statistical problem. And it ignores the larger losses of the broader dot-com market and the myriad of smaller companies that did not survive and are not around. Then you had the subprime bust, mortgage bust, 2007, 2009, another $8 trillion lost. The 2020 lockdown, $9 trillion were lost. And this is just US costs, losses. This is not counting the rest of the world. But the US losses were estimated in each of these instances to be roughly half of what the world lost, at least in the subprime mortgage bust and the tech shock bust. The lockdown was probably a smaller percentage attributed to the US. Going forward, you look at the potential for a future cryptocurrency bust. Now, in August, we had about 20,000 cryptocurrencies in existence. And the market cap, or the market value of these, was put at somewhere between $2 trillion and $2.5 trillion. That was up from $1 trillion at the beginning of the year when we only had 10,000 cryptocurrencies. I think you can see the parallels between the tech stock boom and bust of 1998 to 2001 and where we are with cryptocurrencies. The entire increase, the entire market value of those cryptocurrencies is based on finding someone willing to pay a higher price, the same way it was with the tech stock boom. Central banks and governments, you know, there are people in the market who keep saying that central banks are going to crack down on this. The governmental approach toward cryptocurrencies has been, no, we don't want to do anything about this. These things are going to blow up and implode on themselves, on their own. And we don't want to be blamed, and we don't want to have anybody try to blame us for their ultimate implosion. Let them destroy themselves. A lot of people are going to lose trillions of dollars of money, but that's the free market. There is a guy who is now the head of this SEC who doesn't take that approach. And he's saying, no, we really ought to try to rein these things in before people lose trillions of dollars. We'll see if he succeeds. Now, this is a bubble chart that we produce every month in our Precious Metals Advisory. This one is from May of 2019. You can see a lot of bubbles. The green bubbles are things that are bullish for gold, bearish for the world. Yeah, US housing market decline, higher equity market volatility, international political problems, the deterioration of the EU's economic situation. A lot of those things came home to roost in 2020. But in 2019, they were seen as potentially big issues, but the probability that they would occur in the next 6 months or so was relatively low. Excuse the truck backing up outside, but that's the joy of having good weather and you don't have the air conditioner on. In May 2019, there were fewer high risks events floating on the horizon than there are now. And while they were big, they've gotten bigger. and they were not seen as imminently dangerous. Now, if you fast forward, and this was in our May 2019 Precious Metals Advisory, in February of this year, bigger balls, more of them, and they've moved up into that right-hand corner. Not only are they of a higher risk impact on the economy and good for gold, but they were a higher near-term probability of actually being problematic. And this is where we are today. This is from our Precious Metals Advisory that came out last night, the September Precious Metals Advisory. Big balls, but they're coming down from that upper corner, right-hand corner. The probability of them being problematic in the next 6 months has declined in CPM Group's analysis. So you're seeing people back away from the fear of these problems, and that's been reflected in the decline in gold prices at the beginning of August, and the fact that gold prices did not respond right away. So that's sort of where we are. This is a slide I used several years ago when I gave a talk in Vancouver called How to Invest in Gold and Silver When the World is Not Collapsing. And I started off with this slide. You know, on the left hand, you have the a picture of modern day Kuala Lumpur, city in the sun. Beautiful place, wonderful place to visit. Probably wouldn't want to live there. And on the right, you have that dystopian view of a world in disarray. I mean, human literature is full of future shock, and it's always bad, right? It doesn't actually occur. If you look at history, and you know, a couple weeks ago, I showed you a chart of real GDP growth since the year of our Lord, 0. You know, over the last 2,000 years, human progress has been pretty consistent over the centuries. Doesn't feel that way a lot of times. There are interruptions. There are world wars, Napoleonic wars. There are recessions and depressions. But generally speaking, things have gotten better. But the human psyche is to expect the worst. And we seem to revel in these dystopian views of the future. And fear mongers feed on that. The conclusions are very simple. A, don't fall prey to the human pessimism and the people who market it. And be happy, because other people will fall prey to that dystopian fantasy, and they will be buying gold, helping to keep the gold price high. Now, I bring all this up because I'm going to the Silver Symposium in Coeur d'Alene at the end of this month. It's free attendance, and I encourage people to go. I'm going to be doing 3 things there. The Silver Symposium is an attempt to refloat an idea that was the Silver Summit. And I spoke at the Silver Summit from the 3rd year that it occurred until it really went away. It started in Coeur d'Alene, moved to Spokane, and then ultimately moved to San Francisco. And it was an interesting place where you met silver mining companies and a lot of exploration people who were trying to raise money from smaller investors, and a lot of smaller investors. And you had other people, the fringe that we talked about. The first question that was ever asked of me when I spoke at the 3rd Silver Summit was, I don't know what to believe about you, Mr. Christian, because everything you say is diametrically opposed to what most people believe. And I'm wondering if you're a federal agent sent out here to gaslight us. And I said, well, first off, I don't care what you believe. Second, you should never invest based on your beliefs. Invest based on what you know, not what you believe. And the third thing is you're wrong. What I was saying out there 2005, 2006, whenever it was what most people believe. And those guys were the fringe. And I think I talked about it a few weeks ago. Back then, 90+% of the gold and silver purchased in North America by investors was purchased by college educated, upper income, professional people, 40 to 65 in age, who saw it as a portfolio diversifier and a wealth diversifier and a protection against some of those risks that can come up that can cause life to be unpleasant, either macro, exogenous factors, or factors within your own life, a divorce, house flood, something like that. 10%, less than 10% of the metal was being bought by what they called the guns and bunker people, the conspiracy theorists and other people. Now, the world's gotten a lot worse and the United States has gotten a lot worse, and it looks like about 38% of the population now falls into that fringe. But we still have a few people, we still have a slight majority of people who try to be rational, who try to get their information from books and scholars, who don't listen to guys in filling stations saying, here, drink this cow manure, it'll cure your COVID. Rather, they listen to the tens of thousands of doctors and epidemiologists who have dedicated their lives to it. So we still have a majority of rational people, but there's clearly been an increase of irrational people and people who either have problems thinking critically, discerning good information from bad information, having knowledge about what's going on, being deluded and being self-deluded. I saw this guy, I was a classic example of self-glorification on the internet this week, saying that he was the first person to predict that silver would get to triple digits. It's like, well, no, Jerome Smith in 1981 said that silver would be $100 by 1985. So this guy was 20 at that time. He's not the first to say silver's going to $100. He's probably not the first to be a little bit early by a few decades in such a prognostication. Anyway, I'm going to be at the Silver Symposium. I'm giving a talk called Silver Past, Present, and Future. It's a presentation. It's about 40 minutes, and it's going to be based on what's really going on in the silver market, what has gone on, and what may well transpire in the future. Then I'm going to have an open forum called Challenge Your Assumptions, which is something that I created in the Silver Summit after somebody inappropriately criticized my explanation of how silver trades in the financial markets. So I opened it up to a discussion. And the discussions and the Challenge Your Assumptions went on for years. And sometimes they shifted from being a brown bag lunch, which is what it's going to be this year, to after the banquet, dessert and coffee period, that would go 2, 3, 4, one time 5 hours. And the hotel said, you know, we have to close this up because our staff has to go home for the night. Open discussion. Hey, talk to me about the Treasury gold. You know, there's this guy, Representative Mooney from West Virginia, who sent a very uninformed letter to Secretary Janet Yellen asking about how the Treasury manages its gold. And somebody can get that letter off of the internet and ask those questions. Hey, you know, why does the Treasury hold gold at the New York Fed? Is the gold that the Treasury invested in the IMF in 1944 considered part of the 261 million ounces that the Treasury says it is? The answer is no. But we can explain that. We can answer any question that's reasonable and rational. We will try not to get distracted by the, what do they call it, conflict entrepreneurs, the people who have made a living out of fear mongering and snake oil sales. I don't really want to try to explain to somebody what a futures commission merchant is so that he can further misrepresent the market. We try to avoid the conflict addicts, those people who go out of their way to be abrasive simply because they're abrasive people. And we try to reach out to the conflict victims, people like you and me who watch the world and say, gee, that doesn't look right. I wonder what's really going on there. And we try to go into those kinds of discussions and say, yeah, this is what's happening. This is wrong. This is right. This is good. This is bad. These are efforts that people are making to try to rectify what's wrong with the stock market, the bond market, the currency market, whatever. So we can have that challenge your assumptions. And then I have a workshop on the Tuesday afternoon, which is investing in gold and silver in a world that is not collapsing. In other words, how can you make money and preserve your wealth and make money by investing in gold and silver based on the idea that the world is not about to fall apart? Since, as I showed you earlier, we've gone through trillions of dollars of losses, and each time we spring back. On that happy note, have a good weekend. I will be commemorating the 20th anniversary of the 9/11 bombing. It was traumatic to me, to say the least. And I hope you spend some time thinking about what happened then and all the things that our government has done wrong to not make it the world safer ever since then. Have a good weekend. I'll talk to you next week.